Diversifications versus concentration. What is better for your portfolio? We're going to try to find out in this video. I believe if you are looking for above average returns in your portfolio, you should not diversify. Listen to me again. Do not diversify. Now, don't get me wrong. I think diversification works. But if you compare the returns of a diversified portfolio and a targeted concentrated portfolio, you will be shocked at the amount of money you are giving up. But before we begin this video, you know what to do. Smash that like button, comment below, and subscribe to this channel. Alright, diversification is good for those who are not interested in the stock market, period. Those investors just want to look at their portfolio once a year and just want to retire on it. They don't really want to know what's going on a day-to-day basis. In fact, that's a great strategy for the average person who wants average returns, and that is not a bad thing. In fact, they beat most investors who trade in and out on a daily basis. But in this video, I'm not talking about being a trader. I'm talking about using the same strategy but concentrate your money in only 5 or 6 very powerful stocks. If you have the patience and hold on for the long term, these stocks will generate returns far above a diversified portfolio such as the SPY ETFs or the QQQ ETFs. Don't believe me? Check this out. And let's dive into some explanation on this incredible strategy. Now, I'm not saying not to diversify at all and stop buying any stocks out there. I'm talking about concentrating your investment dollars in companies that are the number one in the industry and have an extraordinary moat around their business. For example, the FANG stocks are such type of companies. Let's compare the FANG stocks returns to the SPY or the QQQ ETFs. But before I do that, let me give you a brief rundown of what FANG stocks are, just in case you are new to this. The FANG stocks consist of 5 high-profile and influential technology companies. They are Facebook, Apple, Amazon, Netflix, and Google. Now remember, Facebook is called Meta now, and Google is called Alphabet. These companies has become household names, known not only for their core businesses, but also for their constant innovation and ability to adapt to evolving technological trends. They have also generated significant market value and has been instrumental in driving the growth of the technology sector, both in the United States and globally. Now let's talk about what the SPY ETF is. The SPY ETF aims to replicate the performance of the S&P 500 index, which is one of the most recognized and followed equity indexes globally. It's diversified across the 500 largest publicly traded companies within the index. And what about the QQQ ETF? Well, the QQQ ETF tracks the performance of the NASDAQ 100 index, which is composed of non-financial companies listed on the NASDAQ stock exchange. It is known for its emphasis on technology and growth-oriented companies. So anytime you see QQQ, generally it's reflecting all the tech companies that's in that index. Now let's compare them and take a look at these charts. As you can see, the cumulative returns of the SPY ETF for the last 5 years is approximately 60%, while the 10-year is 202%. Not bad. You're still getting a good return on your money, better than if you put it in the bank. And the QQQ ETF, they're a little bit better. So in the 5 years, the return was approximately 101%, and the 10-year, it was 398%. Still a great return for an average investors that don't want to look at their portfolio. Now, if you concentrate your money in the 5 stocks of the FANG portfolio, your returns will even far outstrip the ETFs. So let's take a look at the FANG returns. So look at this chart. The 5-year return is 292% for the FANG stocks. And if you look at a 10-year return, the 10-year return is a whopping 755% return. You believe that? 755% return. That's almost double the returns of the QQQ or SPY. So what does this mean? It means if you invested $10,000 5 years ago in the FANG stocks, you will have $39,200. And if you invested 10 years ago, that $10,000 would have turned into $85,500. Incredible returns. And if you invested your money in the Diversify portfolio, in 10 years, you will have a little bit over $20,000 with the SPY ETF. And around $49,000 if you invested with the QQQ. So the QQQ does better than the SPY. So as you can see, the concentrated portfolio beats the diversified portfolio by almost double. See how much money you would have left on the table? Imagine someone who invested $100,000 or $1 million. That's a big chunk of change being left on the table. So I think if you're planning to be in the market long term, then a concentrated portfolio and a couple of incredibly strong leader companies that are earning money hand over fist will give you a leg up over a portfolio that is diversified across over 100 companies. Look, I know what you are thinking. Okay, so you must be thinking that if there's a downturn in the market, wouldn't the concentrated portfolio drop twice as fast as the diversified one? Yes, it's definitely more volatile than a diversified portfolio. So if you can't stomach the downturns, then stick with the diversified one. But remember, this is a long-term strategy. I don't really care if my stocks fall 50% or more if I believe they are strong companies that dominates their businesses. In fact, I would dollar cost average and buy more, because when it bounces back and goes the other way, you will be definitely smiling to the bank. Well, that's my take on diversification. But remember, I am not a financial advisor, and this whole video is based on my humble opinions. So please do your research. I hope you enjoyed this video. And again, please smash that like button for me, comment below, and subscribe to this channel. Until next time, happy investing.